Good afternoon and welcome to today's webcast featuring portfolio managers Sam Lau and Jeff Mayberry. My name is Chris Stegeman. I'm a product specialist here at DoubleLine. Today's webcast is titled Equity Alternatives to Market Capitalization Indices. Today I'm going to kick it over to Mr. Lau in just a bit, but first want to just cover a few housekeeping items. So on the next slide here is our content announcements. I'll draw everyone's attention to Perspectives, which is on the left-hand side, titled Balancing the Scales. This is a Perspectives episode in which Mr. Lau and product specialist Corey Claremont discuss the differences and benefits of investing in equal weight versus market cap weighted indices. And then on the right-hand side, our next webcast is featuring DoubleLine CEO Jeffrey Gunlock and portfolio manager Andrew Hsu. That will be on June 11th, covering markets and the total return bond fund here at DoubleLine. And feel free to always follow us on X, or you can find other videos on youtube.com. Here are some of our media thought leadership. DoubleLine Channel 11, that's featuring portfolio manager Ken Shinoda. Of course, we have the Sherman Show podcast and the Minutes podcast, which again features the guests of honor today, Mr. Lau and Mr. Mayberry. And you can find that live on Spaces every Friday at 1 p.m. Okay, so today we're really going to cover 4 funds, 2 mutual funds, and 2 ETFs. So starting on the top left is the DoubleLine Shiller Enhanced CAPE. That is institutional share ticker DSEEX. Our institutional shares have a minimum investment in non-qualified accounts of $100,000, and the retail share is $2,000. On the right-hand side is the DoubleLine Shiller Enhanced International CAPE, institutional share DSEEX, with the same minimum investments, again, for non-qualified accounts. Below that is the DoubleLine Shiller CAPE U.S. Equities ETF. Ticker on that is CAPE. And then bottom right is the Fortune 500 Equity ETF, which again, I'm going to kick it over to Mr. Lau in just a second here, but that is our newest DoubleLine Equity ETF launched on January 31st of this year. Next 2 slides are just some disclosures from our friends in compliance. And then here we have some performance metrics. So this is looking again at that Fortune 500 Equal Weight ETF. And again, you'll see January 31st, so very short time period. However, it's off to a great start. At least as of April 30th, the fund is outperforming the S&P 500 Equal Weight Index, which is its secondary benchmark. You'll see on the bottom right-hand side there by about 136 basis points over this, again, short time period. Next up is the DoubleLine Shiller CAPE U.S. Equities ETF, CAPE. We launched this just over 2 years ago, March 31st, 2022. And you'll see while performance is positive, it has underperformed the broader S&P 500 index since inception, which Mr. Mayberry will discuss in further detail. Same thing with the DoubleLine Shiller Enhanced CAPE. Mr. Mayberry will dive further into that. This fund has been around since really Halloween of 2013. And you'll see pretty impressive performance numbers since inception with the iShare on the bottom right there up 13.06. That's an annualized or per annum basis versus the S&P 500 index. So just slightly underperforming since inception by 13 basis points. In a period in which the S&P 500 has done quite well relative to the Morningstar large cap categories. And then lastly, the DoubleLine Shiller International CAPE. This is benchmarked to the MSCI Europe Net Total Return US Dollar Index. And you'll notice just slight underperformance since inception on the iShare. So with that, I will kick it over to Mr. Lau to highlight the newest DoubleLine ETF on the equity side, DFVE. Thank you.
Well, thanks, Mr. Stegman, and thanks everyone for tuning in and joining us today on the webcast, which we have titled Equity Alternatives to Market Capitalization Indices. And when we're thinking about what type of title to accommodate this webcast where we talk about our equity-based strategies here at DoubleLine across their various funds, we thought back to a number of the conversations that we've been having, pretty much that began over the last, I would say, 12 months, where speaking to investors out there, they are looking for alternatives to your traditional market capitalization indices like the S&P 500, which have really seen some stellar performance over that period of time. And in part, a lot of that is due to the momentum effect amongst a very tight-knit group of performers, outperformers in the S&P 500. The so-called mega cap names have driven quite a bit of the performance. If you think back to 2023, the top 10 names based on market capitalization within that index accounted for and contributed for 85% of that return of the calendar year total return in 2023. And we've seen a little bit of that wane and slow as we enter into the first few months here of 2024. And I think that just has a lot of people thinking about ways to access the U.S. equity market that just doesn't rely solely on the allocation effect of utilizing market capitalization. So that's what we'll be talking about today across our suite of products here. And as Chris had mentioned in the outset, the first to start the webcast off is going to be the DoubleLine Fortune 500 Equal Weight ETF. The ticker there is DFVE, as you can see on the screen. And we affectionately here at DoubleLine, and we encourage our external friends as well to refer to it as D5, as it just kind of rolls off the tongue when you take a look at that ticker. But this is the first ETF that we've had based using this equal weighted methodology to approach the U.S. equity market. And when I think back to the U.S. equity market, especially with the large cap through the S&P 500, you hear time and time again, we've experienced it ourselves, when you take a look at your own personal accounts and portfolios, that the S&P 500 market cap weighted index is a strong benchmark to use against equity type products because it tends to do fairly well. It's a tough index to beat, let's just say, and a lot of active equity managers out there have found that out over time. But when you take a look at it, and here we have it going back to January 8th of 2003, and the reason for that somewhat seemingly arbitrary date is because that is the inception date, the live period for the S&P 500 Equal Weight Index, which again is going to have the same underlying constituents within the S&P 500. What's going to be different there is the way that these allocations are made. So within the S&P 500, given that's a market cap weighted index, there's a proportionate amount of capital that goes into the index based on the capitalization for each one of the underlying names. For the equal weight S&P 500, it's simply taking the number of constituents and allocating an equal amount of capital to each name there. So when you look back here at the longer course of time, again, going back over 2 decades now, when you see this performance, despite being a difficult index to beat, when you look at the equal weight index, you can see that it's outperformed on an annualized basis going back through that period. And you see there on the annualized geometric return, it's returned somewhere around 11.3% annualized versus the S&P 500 with 10.7 annualized. It's done so with a slightly higher volatility point of 20.4 versus the 18.9. But when you take a look at it, all in all, the overall risk-adjusted returns are right on in line with each other at a Sharpe ratio of 0.6. So with it, the reason why we show this chart here is because despite having being a difficult benchmark to beat, it is possible to at least perform in line, if not better than the S&P 500 over time, simply by looking at this methodology of using the equal weighted allocation. And when we think about overall, the relative performance between these two measures here, you can see what I have on the screen here. And there's 2 things going on this screen, but I'd like to point your eyes first to the information that is going to be represented by the bar chart. That's with the black filled bars that go vertically up and down around that mark of 0 that's shown on your right-hand vertical axis there. And that 0 mark it's basically what we're showing here is the differential in return on a rolling 12-month period between the S&P 500 performance relative to its equal weight counterpart there. And what you can see over time is when, and here, let me just take a step back. Anytime that the black filled lines are above the 0, that means the S&P 500 is outperforming the equal weight version during that 12-month rolling period. Anytime it's below, that means that the equal weight index is outperforming the S&P 500. It doesn't really have an indication of directionality, meaning which or both, or whether both of these indices have a positive return or negative return. It's just, again, a differential between the 12-month returns for those two. But you can see over time that it does have a wiggle and jiggle to it that seems to go around cycles. And in the most recent period that we had, really beginning at the end of 2021, going through 2022, and even today, where the most recent print is through April 30th, 2024, we've had this extended period of outperformance by the S&P 500 market cap indice. They're just the S&P 500 relative to the equal weight. That's come at some time. And as I mentioned in the beginning, that a lot of that outperformance has been attributed to the mega cap names, the top 10 weights of the S&P 500, and also some of the monikers that you've heard of du jour. That in 2023, the big one was Magnificent Seven. That type of outperformance by these mega cap names have led to this outperformance of the S&P 500 to its equal weight cohort. But you can see this wasn't always the case in the years preceding 2022 or so. You can see that there's outperformance for the equal weight relative to the S&P 500. But really, the level that we had just come off of seems to be a near-term high in terms of that relative outperformance by the market cap to the equal weight. We haven't seen these type of levels since going back to the late 90s. And for those of us who have either been around during that period or are students of history, we remember the late 90s going into the early 2000s as being characterized as a market that is somewhat similar, to what you can claim that we are today, where a sector of the market, the technology portion of the S&P 500, through the .com type of names, really drove some of that outperformance, both in terms of the actual returns, but also in terms of how much concentration they represented within the overall S&P 500. And you can see, going back to that period of time in the late 90s, there was significant outperformance for about 5 years in the S&P 500. And then during that downturn, which eventually led to the .com bust, you can see there was a significant underperformance of the S&P 500 to the equal weight index that lasted for another 5 years plus during that period of time. So you can see there are various cycles that it seems to be, the relative performance tends to shift hands between the market cap and the equal weight. A lot of individuals out there, and I think there's some merit to it, do make that comparison to the market that we are in today, with, again, a big portion of the performance being driven by these AI or tech-based names to that 1990 period. But another reason people look to that is shown in the blue line, which shows the percent weighting of the top 10 names within the S&P 500 based on market capitalization. And that is, again, the blue horizontal line going back to 1995. This time, the axis to look at is the vertical axis on the left-hand side. And you can see we're at an all-time high in terms of the top 10 concentration of those names at just under 33%, just under a third of the overall indexes is based on the S&P 500 is based on those mega cap names. You can see the only time we were higher during this period is during that .com time frame, before you had that inflection point where you had a change in leadership from the positive outperformers becoming some of the positive underperformers, and thus that shift to the equal weight. It does feel, again, like we may be, in that type of similar situation. It's not to say that the past is going to be repeated in the future, but a lot of the setup seems to be very similar. And here's another representation of what is giving people pause when they're thinking about solely investing in the S&P 500 for their U.S. equity exposure, and that's the concentration, again, of the market capitalization. And what you can see there on across the horizontal axis, that's the numbered constituent within the S&P 500. So on the very far left across the bottom, that's, let's just say, the top market cap name. Today, that name itself represents 7% of the total index of the S&P 500. The second name drops down to around 6, the high fives, low sixes type of percent. And then you get to the 5% mark for the third highest market cap name. But within there, we have these bracketed out by color. And you can see as you step over from the first 10 down to the next 25, and then the next 25 or so. And then finally, it's not until you get to the next 50 from that entire stack, bringing you to somewhere around the 100 to the 10th constituent based on that ranking of market capitalization, that you really start to get to that trough around that intersect line where it begins to intersect that yellow horizontal line there. And what that yellow horizontal line represents is the weight for each one of the constituents using the equal weight methodology underneath the S&P 500 equal weight index. And with that, assuming a 500 constituent index, that gets you to a weight of around 20 basis points. So you can see it's right around that 100 mark or so on the S&P 500 weight that you start to get to that point. A big component of that concentration is shifted into the top 10 names and then to the next 25 from there. And we can see that visually depicted on this chart as well, where, again, today we are at the highest level of concentration based on the top 10 weighted names of the S&P 500 based on their weight within the S&P 500 at just under a third. You can see there it's at 32.5% for the first 10 names. The next 25 contribute in aggregate another 19 or so. So all of a sudden, in the highest weighted 33 or the highest market cap names of the 35 within the S&P 500, they account for over 50% of the entire weight of the S&P 500. And then you can see this keeps going down as you move over to the right, where finally, where you have the last, 390 or so names of the S&P 500, representing just over a quarter of the index. And you can compare this to the S&P equal weight fill bars, which is highlighted in the gray bars right to the right of the blue bars there. So in looking at that, you can see there's a lot more balance and diversification across these various weights based on again, the proportion being allocated based on the number of constituents underlying that index. So from it, you're avoiding a little bit of that capitalization bias that is right here with the S&P 500. It's heavily concentrated in the large caps, a big underweight to some of the smaller capitalized names through there. So you are getting a little bit more of or significantly more diversified approach to the same names that underlie both of the indices. And it's going to be a little bit more balanced through the experience going forward. Now, when we take a look at that, it doesn't just end based on the so-called size effect based on capitalization, because those can be bucketed into the various sectors of the market. You can see that the equal weight methodology within the S&P 500 equal weight index also leads to a somewhat more balanced and diversified exposure across the sectors. The eye-popping number out there is the 29% of the allocation that's to the information tech sector. So if you're investing solely in the S&P 500 and you're thinking about you want to join in on some of this high momentum movement that you've seen in the technology sector, perhaps you'll add a little bit onto your S&P 500, but you should be aware that right now you're sitting at about 30% of the overall weight of the S&P 500 is within this technology sector. So it's something that you might want to think about. And as I was coming downstairs today to this podcast room / webcast room, I saw that the NASDAQ composite had just reached an all-time high. So certainly a lot of momentum in that sector. And I can find that, that appeal that sometimes, can be sympathetic to it in the sense that, you want to be in those that the best performers, for a reason. There's the birth of the FOMO trade that you don't want to, you have that fear of missing out. And certainly when you start to see headlines like that in the technology component, that you want to be involved in that. But it's one of those things that we like to say with momentum. Momentum cuts both ways, where the positive momentum can be your friend. And they say it's your friend until that trend, until the bend at the end, where if that positive momentum ceases, given that you have a high concentration of your weight within that particular index, that could lead to some of that underperformance relative to the equal weighted counterparts that we saw in one of the previous slides, a la the dot-com bust and some of the other periods in between then and now. So within that component there, you can see again technology representing 29% of the portfolio of the index weight for the S&P 500, relative to that 20 basis points. A pop for the equal weighted version brings you to that 13%, sector weighting for the information tech. But you can see throughout, there's there's a little bit of differences when you take a look at communication services. Also, significant weight to that side in the S&P 500 over its equal weight counterpart. That just implies that the capitalization within those names is at higher end of the index. Another slide here from our buddy Jim Bianco that he and his team put out there is further shows this concentration effect that you've had to a few names there. And this is here where we take a look at the year-to-date contribution to performance in the S&P 500. And here, I think he cleverly named it the NVIDIA and the Fabulous Three, because as we talked about before, there is the Magnificent Five that really drove 2023 returns, Magnificent Seven, I should say, that really drove 2023 returns. But today there's, two have been left by the wayside, as Apple, I believe it is, and Tesla both have negative returns on the year-to-date basis thus far and are underperforming and serve as a drag to the bigger part of the S&P 500 performance. So looking at that from that standpoint, some of these past leaders are becoming laggards. So I did think it was a clever way of presenting it as an NVIDIA and the Fabulous Three, but you can see here, NVIDIA has an outsized contribution to the S&P 500 thus far year to date, and this goes through April 26 of 2024. The remaining three, the Fabulous Three, contributed to just over 1% relative to the 2.7 from NVIDIA. And then you can see the remaining 496 or so names accounted for about 2.4. So again, it further exemplifies some of the concentration that you're seeing based on some of these larger cap names, and thus leads to some of the reasons why people are perhaps looking for alternatives in this U.S. Large cap space. So when we take a look at one other possible reason for why people are looking away from market cap-based indices and into something as an alternative, the equal weight here, as you can see on the blue, darker blue line here, is currently with a forward-looking PE multiple of 17 times, which is a little bit elevated, relative to its history when you look outside of the pandemic period, where it got to a high right around the pandemic to around 22. But right now it does seem to be right around that higher end of the range, but certainly not as high as what we're seeing in the S&P 500 by itself at around 21 times. And this is through a little bit dated. This is through March 22nd. They may have come in a little bit based on recent market moves, but that divergence that you see between these two PE multiples are largely the same today. And when we take a look back at time, again, you kind of see that multiple expansion that you saw going into the 2000 in the late 90s into the 2000 by the S&P 500, where you again had that cohort of mega cap names led by the technology related stocks going into the dot-com boom and then subsequently the dot-com bust. Seems like you're getting a little bit of that divergence, a bit early to tell at this point here, but when it does converge, my expectation is that it's likely going to converge as multiple compression versus, from the S&P 500, driving a big part of that convergence relative to the equal weight index. It's harder to see a earnings growth expansion within there to kind of compress those multiples. So this also gives us pause with the valuation levels of what they are between these two indices, where the S&P 500 equal weight does, on a relative basis, look like it's one of those periods of times where it is worth thinking about spreading some of the chips away from the market cap index. So at DoubleLine, when we were looking to bring our newest offering for the equity market to the table, we looked towards alternative ways to access this. And part of it, as you can imagine, is the equal weight methodology that I've been talking about now for the last 15 minutes or so, actually a little bit more, 25 minutes. I'll have to speed up here to give time for Mr. Mayberry to speak. But the way that we went about it is we also wanted to look at a different constituent base. So for that, we looked at the Fortune 500 list, which is something that is, I think most people are familiar with when they hear the name Fortune 100 company, Fortune 200, 500 company. But for the most part, they may not know exactly what attributes get someone on the list. And from here, when you take a look at the Fortune 500 list, that itself first began publishing back in 1955, where it's focused mostly on industrial and goods producing based sectors of the U.S. economy, which made sense because that's what drove the U.S. economy primarily during that period of time in the post-war era. And then you fast forward to 1995, as the U.S. economy began shifting more towards the service-based economy. That's when the introduction of service-based companies was introduced into the Fortune 500 index, to which it remains today the majority of the underlying names within there. But the way that the Fortune 500 list is selected is based on revenues rather than market capitalization, like the S&P 500. So each year, the folks at Fortune select the 500 companies that have the highest and the largest revenue base for each fiscal year. And from that list is drawn. When you take a look at it as of the most recent publishing back in 2023, those Fortune 500 companies are, as you would imagine, given the revenue base they represent, a big portion of the U.S. economy. And with such impact there, that it represents roughly 2/3 of the total U.S. economic GDP. It has cumulative profits of just about 1.6 trillion, with a cumulative market cap of over 33 trillion in March of 2023, which is about the same market capitalization that you would see in the S&P 500. When you take a look at how we decided, or how this ETF that we use, D5, it applies this Fortune 500 index based on the Barclays Fortune 500 Equal Weighted Total Return Index methodology. So that's combining the two sources of potential outperformance relative to the S&P 500, as well as the S&P 500 Equal Weight Index, both by the underlying constituents represented by the Fortune 500, but also applying this equal weighted methodology. So the process itself begins with the list of the Fortune 500, and from there, to make it more tradable and more realistic as an investment vehicle, Barclays, as the index provider, goes and filters out the Fortune 500 to eliminate companies that are in the private sector, those that are not traded, publicly traded on the NYSE or the NASDAQ. They also exclude limited partnerships, and then they want companies that have been listed for at least 3 months. And then finally, a liquidity filter that's measured through the average daily trading volume is also applied, with those that have less than 5.5 million traded either on a 3 and or a 12-month basis would be excluded. As I mentioned before, the Fortune 500 list is reconstituted annually based on the exchange potential changeover of the constituents underlying that list, and thus the Barclays Fortune 500 Equal Weight Index also reconstitutes in a mirroring of that process there. And within there, finally, once you have the actual constituent list, then an equal amount of capital is applied to each one of the names underneath the index. And then on a quarterly basis, each one of those names are also rebalanced back to an equal weight to maintain that process through encapsulating the equal weight methodology. So what does this look like over time in terms of constituents? For the Barclays Fortune 500 Equally Weighted Index, that means that there's been going back to 1996, an average of 449 names within that Fortune index. And then looking at the S&P 500 as a comparison, on average, it's been around 501. I think a lot of people are shocked to realize that sometimes there's fewer than 500 names in the S&P 500 versus sometimes there's a significant, or there's more. So over time, I can spot check here and see that the high looks like it's been around 506 names back in 2018, the low 498, but on average around 501. And then what is interesting to us here is that thinking about overlap and what constituents that may be in the Fortune 500 index but aren't in the S&P 500, to give you kind of that added differentiation, is that over time, going back to 1996 again, so the last 18 years actually, is 120 constituents is not overlapping from the Fortune 500 index into the S&P 500 index. So a little bit of further differentiation exemplified through that. In terms of just really quickly the pros and cons between a market cap and a equally weighted index is, in the market cap weighted index, when you take a look at that, I mentioned momentum a number of times, and that's because the overall capitalization is tied to and correlated to the overall price of and stock performance of the underlying names. So with it, you saw the heavier tilt towards the larger cap names. with that, that tends to improve also the trading liquidity and leads to that reduced transaction costs that you see that are listed on the left. In terms of cons is, again, you kind of have, suffer the momentum bias when things start to get a little bit stretched in terms of valuation. You saw that 21 or so times forward earnings on the P for the S&P versus the S&P equal weighted of 17. If you look back at the top 10 concentrated names or top 10 largest cap names back in 2023, they had a market cap of around 27 times. So that really lifted the overall PE of the S&P 500 up over that period. The pros and cons of the equally weighted index, one, it's a simple methodology to execute. But what is more important for investors is that it provides that more diversified and balanced exposure, especially that might be important if you start to think that perhaps we're due for a little bit of a leadership change and there's going to be a rotation from some of the outperformers continuing to outperform and eventually perhaps becoming underperformers. And we've certainly seen a little bit of that in 2023 as the breadth of performance has improved in the S&P 500 constituent names. The cons here is part of that flip side. You do have exposure to some of the lower cap names in excess of what you would have that exposure to in the S&P 500. That may limit the scalability as well as increase some of the transaction costs there. But given, again, that the market cap today on the S&P 500 and similarly for the Fortune 500 is right around that 40 trillion mark, I think we're, for DeFi, that's a great problem to have in the future, but I think we're still several billion dollars away from assets from achieving that problem there. And when we take a look at, and again, I'm just showing the index performance. D5 itself was launched just over 3 months and just about 2 weeks ago now. So rather than showing that short performance, we decided to show the live performance of the underlying index that we seek to replicate here through the ETF. And over the live performance time, you can see that the Barclays Fortune 500 has outperformed the S&P 500 equal weight counterpart during that time. You can see also that it kind of wiggles and jiggles similarly to what you expect from the S&P 500. But the behavior, despite that, the similar behavior, you still get some excess return here, where you have the annualized geometric return shown in the table on the bottom right of the Fortune 500 equal weight index at about 12.4% annualized relative to a 10.6 in the S&P equal weight. Again, going back to the live period of the index starting in August of 2018. Similar to what we saw back with the S&P 500 equal weight versus S&P 500, you do have these elevated type of volatility numbers here. But again, you're getting paid for it. To take on that additional volatility in the Fortune 500 index, you're seeing the higher, you're getting compensated for in the sense that you have the annualized Sharpe ratio in excess of that of the equal weight of 0.5 versus 0.53 relative to the 0.48. So from that standpoint, the Barclays Fortune 500 equal weight index should check the box as a potential candidate for those seeking an equal weight methodology towards approaching the U.S. equity market. And then finally here, just really quickly, I'll just rattle off some of the stats before handing it to Mr. Mayberry. You can see here that the total assets as of April 30th, 2024, for the ETF, we had just over 12.5 million. Again, given that short time period of launch. There's a few more holdings in here relative to what's in the index. A lot of that is because we are running an actual investable vehicle here, so we do have some cash positions within there. And then for those that want to take a deeper dive in here, you can always request the slides from us here. I believe you can do it on this webcast platform. You can always shoot us an email at etfinfo@doubleline.com to get further information. But I'll close it off there, hand it over to Mr. Mayberry to pick up where I left off.
All right, thank you, Sam. Let's move on to the next slide here. We're going to start covering, we'll keep it in the ETF space, and we'll start covering the DoubleLine Shiller CAPE U.S. Equities ETF. The ticker of that one is CAPE or CAPE. First off, Sam, you cover a lot of the breadth of the market slides here. This is a pretty straightforward S&P 500 price to earnings ratio. You can see that coincidentally, it's at 25.00 today, or as of last night. The long-term average over this time period, over the past 20-ish years or so, is 18.5. So we're a little bit like 35% above the the long-term average PE ratio today. Similarly, if we look at the CAPE ratio, we're at 33.03 today. The long-term average, as you can see on the screen here, is 24.5. That's also about 35% above its long-term average. And so given kind of the, if you look at these kind of metrics, where the overvaluation or richness of the U.S. stock market, how would you want to be invested? And so obviously Sam talked about being equally weighted, an equally weighted investment. Here we're going to talk a little bit about a sector rotation strategy that we do use in CAPE. CAPE did launch about, as I believe Chris said earlier in the call, about two years ago, 2 years and change ago. And you can see it. The blue line here is the NAV of the ETF, and the gray line or the black line is the S&P 500. And it was pretty close to the S&P 500 all the way up until just about year end of 2023, where there was a pretty large divergence there in terms of return. And we'll get to that in a second. That divergence and why it happened and kind of whether we think it can recover from that. First, let's talk quickly about the how the CAPE is chosen and the sector rotation strategy is done and the sectors are chosen. If you remember, the CAPE ratio is a long-term PE ratio, so it's the current price over the 10-year average inflation-adjusted average earnings. If you look at the bottom left chart here, you can see that if you had a cherry-picked two-sector universe of technology and utilities, if you just invested in whichever sector had the lowest CAPE ratio, it would always be in utilities and never in technology. As a sector rotation strategy, that doesn't really make much sense. So what Barclays and Professor Shiller did years ago was that they created something called the relative CAPE ratio, which tries to normalize what the CAPE ratio should be for any given sector over time, and whether or not that sector like technology should probably trade at a higher CAPE ratio than utilities. And because of this normalization, you can see whether a sector is rich or cheap to its long-term history. And then if you look at the chart on the bottom right, the technology, when it's lower, that's when you would want to be in technology. And very rarely in like early 2000s, you would want to be in utilities over technology in this obviously hypothetical two-sector universe. So how does the index, the Shiller Barclays CAPE U.S. Sector Total Return Index, choose its sectors? It takes all 11 sectors of the S&P 500, calculates the relative CAPE ratio for each sector. Then there's a lot. You take the 5 cheapest sectors according to the relative CAPE ratio. We do apply a value trap filter, so we take out of those 5 sectors, we calculate the 12-month total return for each of those sectors, and whichever one has the worst, so the most negative or least positive return, remove that sector from the universe. As a way to kind of avoid that value trap. The catching a falling knife is always is always another way people look at it. You want to avoid those sectors. So you're left with 4 sectors, and as Professor Shiller would do, as we like to say, as any good academic would do, when you're left with 4 sectors, what do? You just equally weight those 4 sectors, and then you do this calculation every single month. So when a sector gets rich or cheap relative to itself over a month, at the end of the month, we do a reevaluation and choose those 4 sectors again. You can see here on the next slide, this is the relative CAPE ratio over time since 2002. And we do have conveniently, we have the labels on the right-hand side there. They're in order of relative CAPE ratio. So as of the end of April, the 5 cheapest sectors were communication services, real estate, financials, consumer discretionary, and consumer staples. So out of those 5, we would calculate the sector with the worst 12-month total return. And then we would remove that one sector from the index and reinvest in those 4 sectors. So this is the basis for the sector rotation strategy that is underlying the CAPE ETF. You can see here over time, this goes back to 2002. Over time, you can see that it does tend to move in cycles. So what we like to look at is something like financials here. Since 2019, we've been in financials pretty consistently. Communication services, when it first came into the index there in 2018, was in for a solid almost 3 years, was out for a year or so, and has been back in routinely. And tech is in and out, was in there for a long time there, but it has been out of the index since June of 2023. And so it does tend to move in cycles, but it's something that we've, except for utilities, when we launched, we We actually launched the fund. The index went live in September of 2012. So other than utilities, every sector of the S&P 500 has been part of the index. If we kind of focus our attention solely on the CAPE ETF, you can see it's like 369 million or so in assets. And kind of what I wanted to really highlight is the sector allocation side on the right-hand side of the screen. You can see this is as of April 30th. As Sam did mention, tech with large overweight or large allocation in the S&P 500 of almost 30%. So even if we were all in on, or we were in technology with a 25%, equal weight between the four sectors, we would be actually underweight tech. So in this strategy, it would be very difficult, at least at this point in time, to be overweight technology. We'll always be underweight. But we have obviously a very large underweight to technology as of the end of the month. But any other allocation we have across the other four sectors will be an overweight. So as of the end of month, we're overweight financials, consumer discretionary, communication services, and real estate. And that kind of brings us to where we are. Again, this is kind of a very similar chart to one I showed earlier, where we are and what's happened on a year-to-date basis. And this is kind of the crux of what I wanted to get into here today, because when we do look at things, the performance of the index and of the ETF has done very well up until the beginning of this year. And if we look at the sector allocations that has happened so far this year, so from the end of December through last night, we've been actually in communication services and financials for every single monthly reallocation date. Luckily for the index and for investors, communication services is up 12.75%. Financials up 11.25%, whereas through last night, the S&P was up almost 10% exactly on an index level. So both of those sectors have led to some of the outperformance or helped the relative performance, let's say, of the CAPE index. Obviously, when you have that large underperformance, there's a couple sectors. The other two sectors have not really helped out as much or helped out or detracted from returns. And really, when you look at it, in January, we were allocated to real estate, which was down 5%, and materials, which was down almost 4%. Well, the S&P was up, 1.5% or almost 1.75%. So those were very, very large detractors from the returns. And we were in and out of real estate. We've been in real estate 1, 2, 3, 4, or 3 out of the 5 months of the year so far. So it's been a pretty big detractor, really, in real estate. We've kind of moved between staples and discretionary. And we were actually in materials in January. So those allocations have worked okay, specifically, especially the staples allocations worked okay, discretionary, not as much. But it's really that shift into real estate in the kind of rising rate environment that we did see, the higher for longer scenario that we have experienced from the Fed, that has led to the underperformance of the CAPE index and then the CAPE ETF. Now, you might say and look at it and say, well, we're not in technology. Isn't technology driving? It's the largest sector. Isn't it driving a lot of the returns? Surprisingly, through last night, technology was up 7.5%. So out of the 11 sectors of the S&P 500, it was actually the 8th best performing sector. So there were 7 sectors that outperformed technology. So it wasn't necessarily the underweight to tech that has hurt us so far this year. It's actually the effect that we are in real estate that was a big detractor versus the other sectors of the market. And so those of you that, this index has been live for over 10, almost 12 years now, and has performed very well up until, there's going to be some times when it underperforms. But so those of you that believe in the long-term performance of the index, I would say this is the buying opportunity. Those of you that, we've heard some complaints about the index, and obviously the underperformance these days has led to a lot of those complaints. Those of you that think that it doesn't work anymore, then I would suggest that it's not if you don't believe in the reversion to the mean side of things, then maybe it would be a time to get out and watch performance. But those of us, like those of us internally here, we still believe in the long-term performance of the index, and that it should rebound as it picks and chooses the cheapest sectors of the large cap U.S. market. And we think that the long-term track record speaks for itself. Speaking of a long-term track record, let's go to the DoubleLine Shiller Enhanced CAPE. This is our mutual fund, which, as Chris mentioned, launched on October 31st of 2013. This is a little bit different. So the bottom right-hand box there is the same index that we use for the CAPE ETF. but we do an enhancement there. So we invest in this index using swaps. That leaves us cash to invest in a fixed income portfolio, as that's the enhanced part of the name. And what we do is just invest it in it, and we'll get into the specifics of the fixed income portfolio, but we're trying to add a little bit of alpha to the CAPE index from the fixed income side of things. But it's the same underlying equity strategy that leads to all the volatility of the fund. And so I'm not going to cover anymore since we just covered it. But you can see here, so obviously it's a much longer term chart. And when you go back to 2013, you can see very good performance up until really 2022. And everyone knows what happened in 2022. Actually, the CAPE index performed kind of in line with S&P 500 in 2022. It was really the fixed income side. Everyone obviously knows the huge rise in interest rates that occurred over that year that led to a lot of that underperformance and kind of bringing that blue line back down to that black line. 2023, we call it DSEEX from the ticker, DSEEX, performed also in line with S&P 500. And then we've had some underperformance, obviously, in 2024. And it's hard to kind of see in this chart, which is why we had Mark Kimbrough put that little inset in there for you. And you can see that as of December 31st, that blue line was higher than the black line. So as of December 31st, at the end of 2023, the fund had outperformed the S&P 500 cumulatively since inception. All that underperformance has happened subsequent to the end of the year. That's why you see the underperformance there by 37 basis points on an annualized basis. But still, very kind of reasonable returns. These are net returns, so this is net of all costs. So you're kind of getting S&P minus a little bit today, very similar standard deviation and very similar Sharpe ratio. So again, if you believe in that reversion to the mean, this might be a buying opportunity. If we focus a little bit on the fixed income side here, our asset allocation committee meets once a month. We go through and decide which parts of the relative value of the fixed income market make the most sense. And you can kind of see here the yellow bar, you being the U.S. government section, the flight to quality, the safer side of things. We're kind of at our largest allocation to governments we've had since we launched the fund in 2013. And even if you look at kind of the sectors, they kind of move around, wiggle and jiggle. The emerging markets, high yield, it's kind of hard to tell on the screen, but if you go back to like 2014, you have that medium or darker blue. That's the high yield. We haven't had any high yield since 2015 in the fund. But if you look at the EM high yield and bank loans, you can see that it's at the lowest point we've ever been at in terms of our overall allocation. So being a little bit more conservative on the fixed income side, trying not to, again, being good risk managers here at DoubleLine, trying not to take on too much risk on the fixed income side, knowing that there is also that the risk on the equity side of things. And finally, what we still are able to put together a portfolio that yields 6.4. So as we try to outperform SOFR, we have 100 basis points or so of yield on top of SOFR there. Market price of 92. So you do have some potential price appreciation from the fixed income side. And also, as I said, not trying to run like a Barclays or a Bloomberg Ag type portfolio, running very short duration, a 1.3 year type duration. And we're not doing it with swaps or futures or anything trying to manage the duration. It's all from the fixed income sector allocations. Pretty diversified in terms of your credit. 65% of the portfolio, as you can see on the right-hand side, is in credit, but it's diversified across your securitized credit, CLOs, CMBS, RMBS, ABS, and then your corporate credit. You have your investment grade, your bank loans, and your emerging market debt. As I mentioned, no U.S. corporate high yield. So you're really trying to keep a pretty conservative portfolio, trying to add on some value, and that's how we're on that 6.4% yield to maturity. And I know we're running out of time here. Finally, we have the DoubleLine Shiller Enhanced International CAPE. So same thing as the DoubleLine Shiller Enhanced CAPE, except it's in Europe. And we'll just run through a couple slides here. European equities look attractive to U.S. equities. Usually, Jason ran the average here. The average of the average PE for the MSCI Europe is 15.5. So, over this time period. So you're kind of spot on your average there in Europe, whereas, as I mentioned earlier, over on the S&P, on the U.S. side of things, even the CAPE looks much better in Europe than it does in the U.S. And we always like to do these ratios of what is the performance band of something, and look it over at the long term. And you can see that when that blue line is lower, that means the S&P 500 has outperformed Europe. And we're not on the lows, but we're getting pretty close to the lows there. So we expect, or there's that potential bounce back from the European equity market. Won't touch the dollar. This is the similar chart. It's kind of interesting in Europe. You don't have the same, obviously, tech-heavy focus that you do in the U.S. And their numbers, their relative CAPE ratios tend to bounce around very similarly in kind of the same range, whereas the U.S. you see some divergences over time. And then we have been in all of the sectors of the market there in Europe. And here's the performance again. And you can kind of see that, again, more recently, a little bit of a laggard in terms of that black line going above the blue line, but still having some good performance to 7.8% net of fee return there for the DoubleLine Shiller Enhanced International CAPE, similar standard deviation and a very similar Sharpe ratio. If we go to the fixed income side, looks almost exactly the same, 6.6 type yield with same allocations as before. And with that, I think we have a couple of questions. I'll turn it back over to Sam to answer any listeners' questions that are out there.
All right, thanks, Jeff, for that speedy overview of our CAPE-related strategies. And sorry to put you on speed round there. We did get a couple questions here. So let's see. The first one that we have here is asking us to speak on the recent article in The Economist. For those listening, the person asking questions referring to The Economist that came out on April 27th, citing the potential for a bear market, given that the CAPE ratio is near an all-time high and bear market follow the prior peaks in the ratio. So with that, first off, I apologize. I don't read The Economist. I'm going to take over control here, Mayberry. Sorry, I'm just going to try to find this slide, or if you could do for me the CAPE ratio to kind of put up something on the screen while we're talking about it here. But the CAPE ratio was never intended to be a trading signal. I've had, and we on the team have had, the privilege and the opportunity to speak with, Professor Shiller over the past 10 years plus now. And every time, the question comes up on what is the CAPE ratio telling us? Is it telling us to get out of the U.S. equity market and move, elsewhere, or sell everything and go to fixed income? And, he just laughs and says, no, it's not really intended to be a timing metric for when to get in and out of the market, or certainly that, a timing for a crystal ball for when the bear market might be coming around the corner. Instead, when you think about it, the acronym of CAPE stands for cyclically adjusted price to earnings ratio. And the cyclical adjustment in there is the fact that the common denominator used for the time horizon in the earnings is over 10 years. And his way of explaining is thinking about it, since you're looking at a longer look back window of 10 years, the expectation is that you're going to be looking at a longer forward-looking return expectation. At around 33, CAPE ratio that we see on the screen today, he's told me in the past that equates to somewhere around the 3 to 4% real return that's expected on the annualized basis over the long term. So let's just put a number on it, and I'll say, maybe over the next 10 years, that would be what it's implying there. And that's on, I say real return because that's inflation adjusted type of returns that he's looking at over that period of time. But what it's not meant to say is when, well, I guess what you can pull from that is that's a lower type of return over the next 10 years based on an annualized performance number, again, relative to something that might have the time periods where you have a 20 PE, which might imply a 5% type of real return scenario over the next 10 years annualized. It doesn't tell you what the next year return, if it's going to be 10% positive or 10% negative. It's just over the next 10 years annualized return of the mid threes type of return on a real basis. So from that, the CAPE ratio is often misused and miscited within media to be used as a timing metric, to which Professor Shiller would be very much opposed to from that perspective there. There I go, trying to use big words. Makes sense in my head, but not when it comes out my lips. But from that, perspective, hopefully that's an answer to your question. There's always a potential. The bear is always waiting around the corner. I mean, if you ask any fixed income, based shop, which DoubleLine is, we kind of wake up in the morning as a default bear. So if you ask us, it's possible, but over time, again, this is just meant to be a longer term outlook. But I guess I could say in summary is, the next 10 years, average return, annualized return is expected to be lower than if it were a 20 CAPE ratio. Another question comes in that says, if the equal weighted index has almost always underperformed an index based on the top weighted stocks in the S&P 500, why would anyone want to invest in the equal weighted index in the first place? Why not just invest in the top weighted portion of the S&P 500 and forget the rest? That's a good question. I would point to this chart right here. Number one is to show that over time, again, this is since the S&P 500 Equal Weight Index went live back in January 8th of 2003, that you have seen an outperformance of the S&P 500 Equal Weight to the S&P 500. It's a small amount. I mean, you called it, it's kind of blurry here for me, maybe around less than 70 basis points annualized, a little bit more higher standard deviation, but on the risk adjusted basis, it's flat. But over that period of time, I would start out again. People are always talking about the S&P 500 market cap is impossible to beat, but it is a tough market to beat. A lot of it comes from that momentum-based characteristics that you see at the top performers leading the way in an up market. But don't forget, we talked about momentum cuts both ways, and from this period of time that you see here, anything above the horizontal line that goes to the zero mark on the right vertical axis, that's the outperformance of the S&P versus the equal weight counterpart. But look at it. Anything where time it falls below, that means the S&P equal weight methodology is outperforming the market cap weight. And keep in mind, again, here too, that's the same constituents. So there's no different constituents within these two indices. It's just the weighting methodology that differs. So when you start to think about periods where this outperformance of the market cap version versus the equal weight takes place, take a look at kind of the time frame. If you squint your eyes, you can see that going into the .com, that's kind of in a very strong expansionary period of time in the U.S. It's followed by a recession, in the late 90s, early 2000s. That's when the equal weight significantly outperformed. That's where the big winners that drove the momentum-based outperformance into the .com boom drove that same market into the .com bust, into the market cap-based weighting. Similarly, look at the global financial crisis. You had a little bit of an outperformance from the market, cap measure, which also, when you coincide it with that blue line, I don't know if you guys can see my cursor, but I'm rubbing it around the screen right now. On the left-hand side, if you see the peak there in the global financial crisis, you didn't have that same level of concentration in the top 10 names. It was around 22% of the index was based on the top 10 largest cap names. The outperformance wasn't as big. The drawdown the underperformance was rather large. It was about 30% underperformance about the S&P market cap to the equal weight. Again, kind of that change in leadership of not only the stocks based on capitalization, but also, it's not leadership, but a change in the direction of the economy, going from strong periods of growth to economic contraction. That kind of leads us to that point where you're seeing a similar type of setup today, where you have an economy that's doing quite well. You have a market cap based equity index that's doing very well. And it's not to say that it can't keep going, but at some point, when you take a look at the concentration of the top 10 names at just under a third of the overall index, that's the highest it's ever been. It seems time where you might, thinking about from a risk management standpoint, start to diversify some of your dollars around the table. It doesn't have to be in U.S. equities, but if you're looking at the U.S. equity space, and as most of us are American-based investors here, we are going to look to something like the S&P, and you're never going to not own any. But at that time frame, it might be worth spreading around the bets a little bit from that concentration of the top 10 and a third of the overall index. 29% of the overall index being in one sector of the market. It behooves, I think, people to start thinking about, at least questioning a little bit. And I would, say that, again, it's not that the equal weight underperforms over that period, most of the time. I would say it's the other way around, bro, where a lot of times you do see, based on this chart here, that the outperformance, the times where it's below zero on the horizontal line, you have the outperformance of the equal weight to the market cap, and then also the scoreboard argument that I showed earlier, where you're outperforming going back to 2003. The equal weight outperforms by, I can't remember what I said, 50 basis points, let's call it per annum. Don't hold me to it, but somewhere around there. It's not huge, but it's an outperformance with a similar type of vol. What are your thoughts on equal weight versus the RAFI fundamental index? I don't know enough about the RAFI fundamental index to opine here, but if you want to send us that question to to etfinfo@doubleline.com. Maybe we can look into it and get back to you. But off the top of the dome, I would say that, I think if this is the same RAFI index I'm thinking about, it's probably value tilted on that, to which, if you're to look at equal weight indices, because you have some of the more balanced allocation across the names, let's just say 500 names generically, you're probably going to have less growth exposure than something like the S&P 500 market cap weight. So from that perspective, maybe, I don't know, I don't really think of the equal weight strictly as a value type of a play. If anything, it's more of a mean reversion type of strategy because of the rebalancing component that takes place on a quarterly basis. Let's see. How do you suggest we weight the Fortune 500 in our equity portfolio? It depends. I like to start off the generic, answer that I don't like anything being less than 5% in my portfolio when I think about it as a investment strategy. It's not to say that you don't diversify within the 5% across different ways of accessing that methodology, but 5% is a good way to start. It really comes down to it again. I'll point to the earlier charts where the performance is very similar between the two, but between the S&P 500 market, the S&P 500 and the equal weight version. But as you can see on this page right here, there's times where one tends to outperform relative to the other, and it tends to last. And there also tends to be points where there are inflection points. I would say today at 30%, almost a third of the concentration in the top 10 names, you have about 20-ish, what is that? Maybe you have about 10% outperformance by the S&P over the equal weight over the last 12 months. It is a tick down from the last tick. I don't know, it really becomes a timing thing. I think from this standpoint, if you're a buy and a hold type of investor, you can split the difference between the two and you probably have very similar outcomes. But if you fancy yourself as a good timer based on technicals and based on some of what you're seeing in the fundamentals, perhaps you start shifting a larger weight into the equal weight index as you think. And if you think, that's a big if you think that the last 6 to 12 month leaders are going to become the laggards on a relative basis. Not to say that things are going negative, but on a relative basis, you're going to see some outperformance. Maybe tip the scales to the equal weight even higher to, maybe a half or something like that. It's not what I'm proposing, but just ways to thinking about it. If you fancy yourself a timer, it would be a good time to start thinking about moving some of the allocation. Can I get the presentation? Yes, someone will email it to you. I see your email address there. Would you ever modify the strategy to not be underweight tech if you're allocated to it? If we're talking about the Fortune 500 index, then the answer is no. We do not modify that particular, or I guess what the answer is both. It's no. They're both, take their cues from these various indices. I don't see us overriding the index methodology in the CAPE related funds there. In the Fortune 500, the D5, that's an outright replication type of strategy. So that one we would not. We've made our bones with the methodology. We embrace it, and we think that that's the way to go for that particular index, both on the equal weight component for being underweight, as well as the Barclays 500. I'm trying to find the slide while I'm speaking here, and you can see we are significantly underweight the market cap, 29% of tech in the S&P 500 today in the Barclays 500. Let me expand my screen here. That is, what is it? Just under 9%, which is also underweight relative to the S&P 500 equal weight. If you're talking about the CAPE methodologies, then yes, we have underweighted the tech sector based on the times when we're not in it. Sometimes it'll be zero, so a massive underweight relative to the 29% that you see today. As Mr. Mayberry pointed out, I remember it wasn't too long ago, just within a year or so ago, and it's the tech sector was about 25% of the overall S&P 500. So when we were in the index, we're like, great, we're just right at equal weight to the index, which is not necessarily what we're trying to do with, or what the CAPE sector rotation strategy is trying to do, is just be equal weight what the S&P has. But in the sense is, it does have the underweight that we have based on, again, the run up that we've seen to the AI tech related names in that particular sector of the market. And then finally, we have one on the cost of total return swaps. This would be for the two mutual funds, the Shiller Enhanced CAPE U.S. fund, and then the Shiller Enhanced International fund, where, as Mr. Mayberry showed, based on the structure in which we access the equity exposure, we're allowed to free up capital and invest that portion that comes in the cash into the fixed income short to intermediate duration portfolio as the underlying. Here, when we do it, and I just want to make it clear for all our listeners, we don't use the swaps for the two ETFs. It's for the two mutual funds based on the structure of really trying to deliver double value through both the equity exposure, but also through our ability to outperform a cash rate, since we're using that cash to invest in the fixed income portfolio and getting the exposure through a swap to the CAPE index. So with it, it's a long-winded way of explaining, and Mayberry said it before, you're trying to outperform that SOFR rate, the rate of cash, which we think we're able to do with that 6.4% yield, that the maturity on the portfolio of the DSEEX mutual fund today relative to SOFR, which is in the high fours. But also there's a fixed cost that we pay on top of that when we enter into the swaps with our trading counterparties, which is today just in aggregate going to be less than 40 basis points per annum based on the overall exposure that we have on the notional basis to that swap. So if you need more information than that, go ahead and hit us up at fundinfo@doubleline.com, and we can dive into the weeds, since that seems to be more of a detailed question there. But hopefully that gets you what you needed. And that's the wrap up that I see on the questions for our suite of equity-based products offerings here at DoubleLine. Hopefully everyone found it useful. Did want to thank everyone for tuning in to us today, and wish everyone good luck out there.